Okay, we put out some results for the first quarter this morning at 7 o'clock our time, and some few sharp-eyed analysts and press people already picked up one or two items from it, which I'm sure we'll get some questions on later. But if we could start out with slide number 1, which is should be showing now, you'll see that in the first quarter, the way, and we talk about operating earnings at Berkshire, we've explained that many times. This is why we think these figures that we give you are the most descriptive of what's really going on in the business, and take out the wild swings in the market that otherwise just can have us reporting big earnings one quarter and big losses another quarter. We pay no attention to those at Berkshire, but you will see that we had a better than average quarter, and Ajit Jain wants me to point out to everyone that you cannot take the insurance earnings of the first quarter and multiply by 4. It just doesn't work that way in insurance. And while we insure storms around the world, the major storms, for example, that would affect our earnings would be, probably number 1 would be something that went along that came in at the wrong place from our standpoint, and that just kept going up the East Coast, and that's our number 1 risk as we evaluate things. But we're in all kinds of risks. There can be an earthquake tomorrow. There can be an earthquake 10 years from now, and there can, we're in that sort of business. But the first quarter does hit the. Should be our best quarter. Certainly shouldn't be our worst quarter. The most likely quarter to be the worst quarter is the third quarter. But anything can happen in insurance. But fortunately, nothing much happened in insurance during the first quarter. So we had much improved earnings in insurance underwriting, and then our investment income was almost bound to, well, it was almost certain to increase. And I said that in the annual report because yields are so much higher than they were last year, and we have a lot of fixed short-term investments that are very responsive to the changes in interest rates. So that figure is up substantially, and I can predict that one will be up for the year. We've got more money to invest, as we'll get to in a minute, and that's fairly predictable. So that number will be up. When you get into the railroad, the railroad earnings were down modestly, but we should, not immediately, but we should be earning somewhat more money than we are earning under present traffic conditions, and then traffic conditions can also hit the potential earnings of the railroad. And if you want, every Wednesday you can get car loadings from the previous week, and I'll regard you as a little deranged if you do get them, but I get them every week. They're available, and you'll see that car loadings have been running for the industry, have been running down modestly, and these earnings were as is expected, but we should earn somewhat more money than that on the equivalent amount of car loadings. And we in the energy company, we had better earnings, but our earnings were distorted. Well, they were affected by conditions that I wrote about in the annual report, and we'll undoubtedly discuss more this morning. But off a low base of last year, they were up somewhat, and So you get down to the final figure, and 11.2 billion is it's quite an improvement from last year. But we would expect our earnings should go up modestly from year to year, because after all, we're retaining like 37 billion last year of earnings. So if we put 37 billion more, you left it with us, we should do something that's satisfactory. And the goal of Berkshire, economic goal, is to increase the operating earnings and decrease the shares outstanding. It's that simple to describe. It's not quite so simple to pull off necessarily, but that's what we're attempting to do.